First up, let's take a look at the Asian markets. They're trading cautiously as investors digest the conclusion of the trade talks between American and Chinese officials in Beijing. Remember, there was a note from Washington saying there would be a further release in terms of the guidance coming in from the talks. No serious concrete measures being taken. There were talks which were on for about 3 days, and after that, mutual cooperation was something that was agreed upon. Add to that, we have the strength that we're seeing in the dollar yen. Remember, yesterday it was trading at around 108.6 thereabouts. From there, we are seeing strength. That's primarily because the dollar is at its weakest since October, and that's not good news for the Japanese exporters, which is why we're seeing the biggest cut on that index. So the Nikkei down by about 1.5%. Steel makers not doing too well as well. Metals have seen a fair amount of rally over the last 1 week. After the talks have concluded, we're seeing some profit taken off the steel makers. So POSCO is the one that is leading the Korean index, KOSPI down. We're seeing similar amount of mixed moves coming by for both the Straits as well as the Taiwanese indices. 1/3% shaved off the Taiwanese index, but the SGX Nifty, in light of all of this, is a big beneficiary, and as we speak indicates a start around the 10,900 mark. Let's see where we go, because yesterday each time we were trying to cross the 100-day moving average of 10,875, we did see a bit of a sell-off, but we've clocked in 4 or 5 straight days of gain. Let's see how this goes.
Yes, absolutely. Well, just a short while back, China's Commerce Ministry said that the just concluded round of trade talks with the US were extensive and established a foundation for the resolution of each other's concerns. CNBC's Eunice Yoon reports.
It does sound like a positive response, but the Chinese have been saying that they do really want to have these trade talks come out as a success in order to try to avert some of the trade tariffs that have been hurting the economy, as well as the overall sentiment within the markets, and not only here but also in the rest of the world. So it's not surprising that they would be optimistic, at least on the surface, though one of the points I think that was interesting that you had raised was that they had mentioned that there were a lot of detailed discussions, but we still don't have what those details are, and that has been a bit of a disappointment so far from those who follow the trade talks very closely. We didn't have a lot of detail from the USTR as well. So the Trade Representative's Office had put out a statement where they said that the discussions had focused largely on a pledge by Beijing to purchase a, quote, substantial amount of farm, energy, and manufactured goods and services from the U.S. The office also had pointed out, though, that there was still a long list of issues when it comes to structural changes that that the two had talked about, but really still needed to be addressed. And also, they said that there was a need for an agreement of some sort to include a mechanism for verification and enforcement. And that's the big sticking point for these discussions, that there just hasn't been a lot when it comes to some of the tougher issues. And we're already halfway through this 90-day negotiating period, and there's still a lot to be done. I think what's also going to be interesting is to see how this all boils down to the top negotiators. And by top negotiators, I would say President Trump. So whether or not President Trump believes that the Chinese are really going far enough is a big question, especially when it looks as though the White House is still divided in their approach towards China.
Okay, so that's the update coming in with regards to the US and China trade talks. But on Wall Street, what happened? US stocks closed higher for the 4th straight session, with the S&P 500 in its longest winning streak that we've seen all the way back since September. The Dow rose 91 points, while the Nasdaq climbed almost 1%, led by gains in the tech giant Apple. Reports of US and China have narrow differences over trade gave some support. Also, minutes from the December Fed Open Market Committee, or the FOMC meeting, which indicated caution on future interest rate hikes, helped to support sentiment. CNBC's Kate Rogers gets us a wrap of all what took place on Wall Street.
U.S. stocks finishing higher on hopes of a China trade deal and the possibility of fewer rate hikes this year. The Dow up 91 points today, the S&P gaining 10, the Nasdaq higher by 60. This one may not be good news for drivers. Crude oil is back up to $52. That's $10 more than 3 weeks ago. Right now, gas prices nationwide are holding at $2.23 a gallon, 26 cents less than last year. But as we know, gas prices rise faster than they fall on oil's price movement. The stalemate in Washington, D.C., one of the longest in history, is now throwing a wrench into some people's plans to buy houses. So far, nearly 40,000 mortgages could be caught up in the shutdown, according to online real estate firm Zillow. A survey from the National Association of Realtors says 20% of realtors say they had either a current or prospective client impacted by the shutdown. Amazon CEO Jeff Bezos announcing in a tweet today that he and his wife of 25 years, Mackenzie, have decided to divorce. The tweet suggests that it will be an amicable parting. Bezos founded Amazon in 1994, just a year after they were married. His 16% stake is valued at around $130 billion today, so she could be legally entitled to half of that, or around $65 billion. That's the action from the U.S. market. Back to you in Mumbai.
All right, the action from the US market, also the big development happening, the personal development happening in Jeff Bezos' life. $65 billion is the entitlement for his wife. That would make it the most expensive divorce in history. But let's move on then. Minutes released from the Federal Reserve's December meeting indicate that the rate hike could come, or rate hike came with reluctance from a few members who thought the lack of inflationary pressures and argued against another increase. The minutes also confirmed patience regarding future rate increases. CNBC's Elon Mui reports.
We got a little bit of a vocabulary lesson in those minutes. The sentence that had caught everyone's attention in that December statement was this, that the Fed judges that some further gradual increases are warranted. The minutes show that the use of the word some was intended to indicate, quote, a relatively limited amount of additional tightening. Also, the use of the word judges, that was supposed to convey the Fed is data dependent. So all of this just underscoring the fact that the Fed is uncertain about how this economy is going to evolve. There was a lot of debate in the minutes over the solid economic data versus the wild market swings that we've seen lately. Generally, the Fed believes the economy is doing well, but when they look at the market volatility, they look at the slowing outlook for global growth, they look at trade tensions, the flattening yield curve, all of those weighed on Fed officials. The minutes said that those downside risks, coupled with the fact that the December rate hike puts the Fed funds rate at or about right at neutral, that, quote, made the extent and timing of future policy firming less clear than earlier. The minutes also talked about the Fed's desire for patience. They want to see how these risks play out in the economy, how they affect future economic activity, and how previous rate hikes sort of ripple across Main Street. All of those factors help contribute to the Fed lowering its estimates for GDP and also the lower estimates for Fed rate hikes in the future. The minutes also showed that a few participants did not want to raise the Fed funds rate in December. They argued that there's little sign of upward pressure on inflation. They also wanted to see the markets calm down before they had any further action. We know that the Doves lost that argument in December, but there was discussion about removing forward guidance in the statement and moving toward some more data-dependent language more broadly. Obviously, the Fed's outlook is going to evolve. They want their language to evolve too, guys. Back over to you.
Okay, well, on that note, let's listen in to what experts have to say about the impact on markets of the government shutdown and the Fed policy stance going ahead.
Gridlock that it's evidence of is basically telling us that the types of things that the U.S. government could have done in 2019 that would have alleviated some of the pressures that markets are feeling now from policy choices in 2018, i.e. putting in some fiscal stimulus and therefore putting pressure on the Fed's dual mandate in 2019, those things are very unlikely to happen, right? So I wouldn't look at the government shutdown as problematic in and of itself. Even. This is still going to be, this is emblematic of a drag on the market that's going to continue for 2019 because it's telling you that there's really no path towards any meaningful legislation like infrastructure expansion or anything like that that's going to undo some of the downsides of fiscal stimulus that we're going to feel this year.
What are the things we care about? We care about corporate profits. We care about the Fed. And I think the big story out of Washington this year is that the Fed is going to be done with this cycle. The futures market is telling you right now that the Fed will not raise rates again. They are finished. And the next move will be a down move in 2020. That's not the Credit Suisse view. That's what's actually baked into the market. And when investors in equities realize that that is, in fact, the path that we're going to go on, I think that you get further upside. That along with the fact that the earnings are going to be not stellar, but fine.
Balance sheet, if you look at the balance sheet, the majority, almost $1 trillion in holdings, is maturing in the 1 to 5 year time frame. That's what is rolling off the balance sheet. That is also where the U.S. government's expanding their issuance, $1.3 trillion the next year. This is where you're really seeing the backup in interest rates. The 10-year rate has come down now at 270, was down to 260s after those comments. So I don't really understand why the market is so excited about this, A, or B, nervous about the Fed continuing to proceed. We'll see. They will adjust. They will be flexible. They will be patient. This is standard Federal Reserve rhetoric.
All right. With that, we move across the European markets. Then they ended in the positive territory. In fact, they hit a fresh 3-week high as investors grew confident that the US and China will reach a trade agreement. Remember, the European markets ended as the trade talks were still on, and we saw the autos as well as the technology sector doing fairly well. On to the Brexit developments then. The UK Prime Minister Theresa May's Brexit withdrawal agreement suffered an early defeat as lawmakers voted for the government to swiftly come up with a plan B in case the deal is voted down next week. So that is something the investors will keep an eye out on as well. If you take a look at the emerging markets, the Brazilian index was the one which really stood out in terms of gains. In fact, from the start of this year, that index has gained about 4.5%, has outperformed major indices of the world just the way it has done in all of 2018 as well. So the Brazilian index ending with a gain of about 1.7%.
Okay, well, let's tell you about the currency space then. We have the dollar, which is under pressure on growing expectations that the Fed Reserve will pause its rate tightening cycle this year. Optimism about the China-US trade talks reduce demand for safe haven assets.
The world of commodities. Crude oil prices rise on a bearish US stockpile data after Saudi Arabia reassured the market that its oil production and exports are falling sharply. Positive talks between the United States and China also supported prices.